Hey everyone, this is Kirk here again at OptionAlpha.com, and thanks so much for checking out this video tutorial. I want to cover the trades that we made just the other day on June 17th. I didn't have a chance to go over those trades, Tuesday, June 17th, that is. I didn't have a chance to go over those trades in a video because I had family in town for the night, so I wanted to talk about those trades specifically, and then today, Wednesday, June 18th, we actually didn't have any trades that we placed through the market, so it actually just kind of works out pretty good. So again, this video tutorial, even though it's being recorded on Wednesday night, didn't have any trades on Wednesday, but these are all trades for Tuesday, just to recap. So there's no opening trades that we entered on Tuesday, and obviously nothing new that we entered on Wednesday either. But I do want to go over some of the closing trades and then also the adjustments that we made to a couple of our positions. First one I want to go over is XLF. Now, XLF obviously is a June contract. It was one of those ones that we sold a credit spread above the market, anticipating that XLF would go lower or financials would go lower. And they did for a little bit, but just kind of turned around on us right here at the end. And so just didn't have a real good opportunity in the last couple of weeks to turn this thing into a nice winner. It got very close, but didn't really get the type of profit that we were looking for. So went ahead and bought this back for less than, obviously, a full loss. A full loss would have been $1 wide, so we saved a lot by just buying this back at 65-cent debit. We know that it's kind of out of the window of opportunity now, and thankfully we did, because financials continued to rally this week, or yet today on the 18th here, and so prevented us from incurring further losses. So we took a $40 loss on those and just continue to move along. The next one I want to go over is actually VZ first, and then we'll talk about the RUT. But Verizon is one that we had bought a debit spread on Verizon and anticipating that it would go lower. So we bought the 49.48 debit spread. And pretty much right after it happened, Warren Buffett said that he was going to be investing a lot of money in Verizon, or already had created a substantial position in Verizon. So we never again got that type of movement back down that we need to see in Verizon to really turn this thing into a profit. Just kind of continue to move higher. And again, it came very close, but never really kind of broke where that barrier was that we needed. We really needed to go under 48.5 to make some money on this trade. So never really got there, but again, wanted to save a little bit of premium that's left in it. So went ahead and sold this thing back to the market since we had originally bought the spread. Went ahead and closed out the trade by selling back to the market our 48.49 put spread for a 12-cent credit, so took in a $35 loss on that trade. All right, so let's talk about this big RUT Iron Condor. This has been a huge trade for us, not in size-wise. It's actually a very small trade in size-wise, but as far as just learning trades and adjusting trades along the way. And I want to spend a little bit of time just, again, kind of recapping what we did with this trade so you guys can see logically what our thought process was along the way. And we talked about it a number of times in video tutorials, but again, we closed out the trade today. It was a loser in the overall closing it out, and we closed out both sides of the trade. So we had our call spread and our put spread from our original Iron Condor. But what's really great about this trade and some of the other adjustments that we made this month is that this was originally a trade that could have been a $400 to $500 loss. And we turned it down, or whittled it down to about a $145 loss after all the adjustments. So again, just to kind of recap what we did, and let's just use the chart of RUT to as an example of what we did. We originally had this 1140, and I believe our first position was a 1080 position or even lower position in the market. And so we originally had this position when the RUT was trading right about in this range, so kind of near the lows. And you can see it just went all the way against us the entire month. So really not the ideal situation that you want to have happen with an Iron Condor, but if we would just let this thing go, it would have turned into a full loser, and obviously way more or way bigger of a loser than it actually ended up being, which is a small loss of $154. But as RUT continued to move lower, we would close out our put side trade. So we'd close out that side of the trade, and then we'd re-enter the trade somewhere else a little bit higher. So again, continuing to roll up this put side trade closer and closer to the market. And as RUT continued to trade higher, we would close out this position, and we would again roll it up to something closer near the market. Now, in the case of our last roll up, we actually went inverted. So our put was actually higher than our call spread originally was. And so we were inverted and basically had risk between about 1150 and 1140. Now, as RUT continues to move higher, we've basically capped our max potential gain. In this case, we've capped our losses and we really don't have any extra additional loss if RUT goes higher, and we don't either have a gain or have a gain either. But by rolling up a couple of times, I think we did 3 or 4 times in the RUT, just rolling up that put side trade, and each time taking in more credit, we were able to whittle down the potential loss on this trade, although the stock went completely against us. So even from the get-go, the stock or the RUT went 100% against our position. Really not the ideal situation. Never gave us an opportunity to really see the market kind of turn back over and give us a window of opportunity. But this again is the essence of trading, is being able to take what looks like a full losing position and whittle it all the way down to a $154 loss. So in my book, I'm really excited about this trade. That's a lot of work for a $154 loss, but it sure beats taking a much bigger loss if we did nothing. All right, let's go over the other two adjustments that we made on current positions. The first is we got out of our partial exit of our Netflix calendar or diagonal that we currently have in Netflix. Again, a trade that we have adjusted and kind of whittled down some of the loss on that one as well. And so what we did is went ahead and sold back to the market our in the money or out of the money put spread for $160 credit for July. That basically just leaves us short a 405 put for June expiration, which should, for all intents and purposes, expire worthless unless something crazy happens. So we are short a 405 naked put for June for Netflix. You can see here on the Analyze tab that Netflix is trading all the way up here at $448, and our strike price is all the way down here at 405. So I don't think there's a chance that this is going to get hit in the next day and a half, but again, that is the risk that we're taking. And at this point, we just want to kind of let this one expire worthless and be done with it. And then again, we'll kind of cover our total adjustments and risk and profit loss for that trade. The other trade that we had, or adjustment that we had, was we entered a vertical roll for our EWW position. Now this again is a great example of rolling a trade that makes sense to roll it out to the next month. And what I always say is that with roll, especially with credit spreads, you want to pay or you want to get a credit for rolling out to the next month. Well, in this case, our original EWW position, which was the 68.66 June put, was entered for a debit. It was a debit spread. So with debit spreads, when you roll those out to the next contract month, you want to pay as small as possible of a debit because you're basically buying more time. And obviously time costs money. And so you want to minimize that cost of rolling out to the next expiration month. So on Tuesday, on Monday, what we did is went ahead and rolled out our EWW. We rolled it from June to July. So you can see that now we have the July active, which is this contract month, and we closed out of this contract month in June. We still stayed with the exact same strikes. So we still worked with the 68.66 debit put spread. And here's the best part is that we only paid $1 to actually roll this trade out for next month. So think of it this way, is that we bought an entire extra month of time for this trade to turn into a profit for only $1. So it's a really, really profitable way to roll a trade, very risk-free, rolling out to next month, and keeps the trade alive, really. Kind of keeps the trade on the dance floor, ready to go in case we do get a nice move down in the stock between now and expiration. So had that opportunity just the other day. EWW has now moved away from us just a little bit here today, but again, with our break-even price right around 67, at least we have some extra time to see if this thing would turn into a winner, at least in July. Now, had we not done this just the other day, so we actually executed this trade just here when it was right around break-even point, we'd now be looking at a potential full loss on this trade in just one day. So by kind of rolling the dice close to expiration and seeing if it was going to go in the money or out of the money, we'd now be looking at definitely a full loss on this trade rather than having it still active for next month. So again, really great timing, and we didn't obviously know that was going to happen. It just ended up happening to be that way. All right, so hopefully you guys enjoy this video. As always, if you have any comments or questions about the trades that we made here tonight or any of the trades in our portfolio, again, please ask your comments right below here in the comment section. I'll get back to all of those tonight or tomorrow before the open, and happy trading.